Bonds are financial instruments used by governments, corporations, and other institutions to borrow money from investors. Essentially, bonds are a way for these entities to raise capital for their operations or projects, with the promise of paying back the principal amount plus interest over a set period of time. Bonds typically have a fixed interest rate, which is determined at the time the bond is issued. This interest rate, known as the coupon rate, is the amount of interest that the bond issuer agrees to pay to the bondholder over the life of the bond. Bonds can be bought and sold in the bond market, which operates much like the stock market. Bond prices fluctuate based on a variety of factors, including changes in interest rates, the financial health of the bond issuer, and overall market conditions. There are several different types of bonds, including government bonds, municipal bonds, corporate bonds, and international bonds. Each type of bond has its own unique characteristics and risks. Government bonds are issued by national governments and are considered to be among the safest investments. These bonds are backed by the full faith and credit of the government and are generally seen as low-risk investments. However, government bonds typically have lower yields than other types of bonds, due to their relative safety. Municipal bonds are issued by state and local governments and are often used to finance public projects such as schools, highways, and water systems. These bonds are generally exempt from federal taxes and may also be exempt from state and local taxes, making them attractive to investors seeking tax-free income. Corporate bonds are issued by companies to raise capital for a variety of purposes, such as expanding their operations, acquiring other companies, or investing in new technologies. These bonds typically have higher yields than government bonds, but also come with a higher level of risk. The financial health of the issuing company is a key factor in determining the risk associated with corporate bonds. International bonds are issued by foreign governments and corporations and are denominated in currencies other than the investor's home currency. These bonds can provide diversification benefits to investors, but also come with currency risk and geopolitical risk. Bonds are typically issued with a set maturity date, at which point the bondholder receives the full principal amount of the bond. However, bonds can also be callable, meaning the issuer has the option to pay back the bond before the maturity date. This can be advantageous for the issuer if interest rates have fallen since the bond was issued, as they can then issue new bonds at a lower rate. Bonds can also be traded on the secondary market, which allows investors to buy and sell bonds before they reach maturity. The price of a bond on the secondary market will depend on a variety of factors, including changes in interest rates, the credit rating of the issuer, and overall market conditions. In summary, bonds are a key component of the financial markets, allowing governments, corporations, and other organizations to raise capital from investors. While bonds are generally considered to be lower risk investments than stocks, they still come with their own set of risks and should be carefully evaluated before investing.